All right, here we go. All right, good evening, everyone. Today we're going to be talking about cost analysis and cost estimation. And I'd like to share at least 5 key points with you before we dive into the slides. One is the definition of cost. With example, definition of cost, okay? Here, typically we define cost as the process of using up an asset or a liability. So if you use a furniture, it becomes depreciation cost. If you use a person, you pay them salaries, right? If you use somebody's money, you pay interest cost. That's the definition that we get from financial accounting. But from a cost accounting or managerial accounting perspective, we are referring to cost of raw materials, cost of materials, cost of labor, and then overhead cost. You can see that the financial accounting definition focuses a little bit more on overhead than the rest of it, right? But these are also costs. When you are making, let's say, a shed or a camera or a computer, you are making anything, you're gonna have to deal with material costs. And those raw materials, for example, could be cotton, wood, it could be the cost of hardware that you use to make a computer, it could be the cost of food that you are going to prepare, right? Those material costs are direct. They are directly linked or it can be traced to the final product. Keywords are, can you trace it to the final product? Okay? This is one of those costs that you can trace to the final product. You can trace the cost of cotton to the shed that I'm wearing, right? The cost of hardware to the computers in front of you, and the cost of furniture, the wood and stuff that you're using. All those are direct materials. That's easy. That's the direct cost. Okay? And then direct labor is people that work to deliver the final product. Like the carpenter that cut these furniture into shape, the seamstress that made this shed, right? The person who makes the iPhone. Their cost is also directly attributable or directly linked to the product. So those are direct costs. And those are not difficult because they are variable costs. They vary with the product. The more cotton you use, the more shirts you can make. The more wood you use, the more furniture you can make. Those are direct costs. The more hours that this person spends, the more cost you're going to incur on the product, right? So those are easy. The problem becomes the overhead cost, which we can generally divide. We typically refer to these as indirect costs. They are indirect costs in the sense that you cannot directly trace it to the final product, but you can attribute it, you can allocate it to the final product. And those indirect costs, we could say, could be fixed costs, or it could be variable cost. This is what we are learning tonight, the difference between fixed and variable cost. And we are going to take it up, down, and middle, okay? That's what we're going to do. So make sure you understand. So what is the definition of a fixed cost? We can give you 2 definitions. The first definition is fixed cost is any cost that in total remains the same regardless of the level of activity. Cost like what? The cost of a building, you could say the salaries of supervisors that do not directly produce staff. Those are all fixed costs. So you can define it in terms of total. It's constant. Does not change within the relevant range. But if you define a fixed cost in terms of per units, as you divide it by the number of people, you divide it by the number of products, it is going to reduce. Right? Because if the fixed cost, for example, to run this room, the utilities cost, to run this room, we know is $10,000. In total, it's going to be $10,000. But if you put 10 people here, $10,000 divided by 10, you are getting $1,000 per person. But if you put 100 people here, is going to be $10,000 divided by 100, and you are going to get $100 per person. So per unit, fixed cost is going to go down, but in total, it remains constant. Does that make sense? So whenever I say what is fixed cost, don't say it is the cost that remains constant. You have to say that in aggregate or that in total remains the same within the relevant range. Does that make sense? And then if you can also say, however, on a unit basis is going to decline because you are spreading the total fixed cost across several units of activity. Right. And the units of activity could be hours, it could be products, it could be people, it could be whatever many people are using that fixed cost. Does that make sense? So if you were to draw a graph for fixed cost, and the y-axis is going to be the dollar amount, which is the fixed cost, and this is the unit, whatever the unit is, whether it is people, Coke, cans of Cokes, or whatever it is, you put that here. Fixed cost in total is going to be like this, in total. So this is your total fixed cost. TFC, total fixed cost. However, per unit, as you increase the number of activity, fixed cost is going to decline. Does that make sense? All right. Now, let's say you have a house and you rent a place, and your mortgage is $2,500 a month. It is fixed. You pay $2,500 every month. That's what you pay. If it's just you and your wife in the house, $2,500 has to divide it by 2, right? Is 1,250 per person. But if you have 8 more people come and live in the house, you have 10 people now. So instead of 1,250, it's 250 per person. Does that make sense? That's what we're saying. So as you spread fixed cost over several number of units or people or products, it gets lower and lower and lower. Does that make sense? If I have more students in the class, the cost of running this class is the same if I have 1 student or if I have 1,000 students, right? So that's what we're talking about. Does that make sense? Now let's talk about variable cost. Variable costs that are indirect variable costs are costs that will in total decrease within the relevant range. It will decrease, or it can also increase within the relevant range. But on a per unit, that's total variable cost. It can increase or decrease within the relevant range, depending on how much you're using. But it remains the same as a unit of activity. We're going to explain what we mean by that. So let's say we are looking at phone calls. And if you make international calls, you don't use WhatsApp because WhatsApp is free. But you use your phone to make international calls to London or some other parts of the world. The more calls you make, the more you're gonna pay. So the calls in total is going to increase as you call more and more. Does that make sense? Okay. However, the unit rate, the cost per call per minute is the same. Say it's 2 cents or $1. It is not gonna change. So notice these characteristics about the average variable cost, AVC. Average variable cost, this is also called average fixed cost. The average variable cost remains what? The same within the relevant range, but the total variable cost will change, will increase or decrease depending on how much of the relevant range that you use, how much of the units that you use within the relevant range. Does that make sense? Yes? So think about the cost of your phone bill. If you don't make or you don't receive a phone call throughout a month, you will still get a bill. You will get a bill because they told you the cost of the plan is $20, right? And so they'll send you that. And as you make that, that's what we call the fixed cost component of your phone bill. Does that make sense? It's fixed. And as you make more calls, the variable cost is going to be going up. But the cost for each call per minute is the same. That's the average variable cost. Does that make sense? So 4 things I want you to keep in your mind. 1, total fixed cost remains the same. within the relevant range of activity, the total fixed cost. Does that make sense? Like the rent, like the mortgage that I talked about, like the cost of running this room, it's the same. Average fixed cost will increase or decrease, or it will decrease as you increase the number of units or volume of activity over time. Does that make sense? The average fixed cost. Similarly, total variable cost is going to increase or decrease as you increase or decrease the level of activity. Does that make sense? Total variable cost. And then the average variable cost is going to remain the same over time. That's the cost per unit of making a call, something like that, right? So, we learned from algebra that if you want to know the dependent variable y, you could say mx or mx plus b, right? If you like. And we know that we can also say that's the total cost equals total variable cost plus total fixed cost. Right? Total cost equals total variable cost plus total fixed cost. Which we can also say that total cost then is average variable cost times the number of units, let's call it x, plus your total fixed cost. So in this case, the intercept or the slope, the intercept of the line is being quoted as the total fixed cost. Does that make sense? So if you were to draw this graphically, you would say, if this is 0 and this is cost, and this is the number of units, then you would say, here is your B, which is your slope, and that's your fixed cost line that remains the same. Does that make sense? Okay. And the slope of the curve, which is your average variable cost, which is your M, right? The slope of the line, which is your average variable cost, is also going to be constant. My son would tell me the slope is what? Rise over run. Right? Rise over run. If you were to find the slope of this curve, this line, you would hope that it would be constant from here to here to here to here to here. And there are different ways of finding the slope. You can use a regression to find the slope. We can let you use your eye visual inspection, or we can use something that we're going to love called the high-low method tonight, which is what I wanted to talk to you about next. And I'll stop and then we can take questions. So that is B, and then so your total cost is the summation of the fixed cost and the variable cost. That's your total cost line. It's this plus that. But if you think about it, in terms of the phone, you couldn't say that it is fixed cost, you couldn't say that it is variable cost, so you could say it's mixed. It has fixed cost components and it has variable cost components. So that's what a mixed cost is. Now, to round this up, I want you to remember that 1, 2, 3, 4. 1 is, I want you to remember how to calculate the average variable cost. ABC. Which in this say we said is M. Is the slope, also called M, or the slope, using the high-low method. Okay? We are going to say our highest cost minus our lowest cost divided by our highest outputs minus our lowest outputs. High-low method. Take the highs, subtract them. Take the lows, subtract them, divide the dollar by the units, and that will give you the answer. So for example, if our highest cost was 2,800 and our lowest cost is 800, then that difference gives us what? 2,000. And if our highest output was, let's say, 1,200, and our lowest output was 200, then that difference is going to give us what? 1,000 in units, 1,000 units. And 2,000 divided by 1,000 is what? $2 per unit. $2 per unit is the slope or the average variable cost. That's the first number you need to learn how to calculate using the high-low method. And when we do the high-low method, we want you to focus on the highest output and the related cost to that highest output, and then the lowest output, and then the cost of that lowest output. Okay? You have to remember this. Does that make sense? You're going to ask you to do it. High-low method. Okay? Once you calculate the variable cost per unit, then you can use that to calculate your total variable cost, which will be your $2 that you just calculated, multiplied by any one of the output units, whatever you want. Do you want the 1,200 or do you want the 200? You pick one, but be consistent. Let's say you wanted the 1,200. $2 times 1,200 units will give you what? $2,400. That's your total variable cost. Make sense? Once you know your total variable cost, you know your total variable cost and you know your total cost. So now you can calculate your total fixed cost. Does that make sense? Because we know that total cost equals what? Total variable cost plus total fixed cost. But we know that this is 2,400, and we know also that this is 2,800 based on the math that we did there. So therefore, what is the total fixed cost? It's 400, right? Yeah. Does that make sense? Because 400 is the only number you're going to add to 2,400 to get 2,800. Does that make sense? Yes? Get it? So that must be what we are asking you to calculate. Right. And then once we ask you to calculate this, we are now going to ask you to do what we call break-even analysis with this kind of information. We are going to ask you. So if I really want to trick you as a professor, what I'm going to do to you is I'm going to give you the information and I'm going to ask you to calculate what your fixed cost is. But in order to calculate your fixed cost, you must have gone through to calculate your average variable cost, your total variable cost, and then you must know your total cost and subtract it and get your fixed cost. And once you get your fixed cost, then I'm going to ask you to calculate some information related to profits, when profit is zero and when profit is not zero. That's what we're going to call break-even analysis or cost volume profit analysis. Okay, good. Peace out.